Well, so that's basically what we are watching out for and what's coming up on the show. Fook Hien Yap is Senior Investment Strategist at Standard Chartered Bank. He's joining us right now. Mr. Yap, great to have you with us here. Thank you very much for your time. I hope I got the name right. Please feel free to correct me if I did not. Just a quick word, Mr. Yap, on how things are set up. We have sort of regional banks in the US which are sold off. There is, as I was saying, no real smoking gun, at least not that I can see. No one real big catalyst which led to the sell-off last night. And then we've got the Fed meeting sort of later today. Do you think what's happening with regional banks will lead the Fed to be a little less hawkish if they were planning to be hawkish? Does it moderate the outcome later tonight?
Yeah, I think pretty much in line with consensus, we do expect the Fed to be raising rates by another 25 basis points when they meet later on. And after that, we expect the Fed to pause for a little while. And then we do see another 50 basis points cut towards the end of the year. And that is our base case, which is not too different from where the futures and money markets are pricing in at the moment. And, our view is we are underweight on equities globally because we do see an 80% chance of a recession in the US. And, the saying has been that the Fed will hike until something breaks. And we saw something break with a few banks being taken under control by the FDIC. And over the weekend, as you mentioned, with the First Republic being taken over by JP Morgan. So we have a sector view as well for the US. And back in March, we actually downgraded US financials to be underweight because we think the large banks will do well and they're actually gaining market share. But it's just the worry about the regional banks and the smaller banks, which are regulated a bit less tightly, and whether there's worries about a bit of a domino effect and how that might affect the rest of the sector's sentiment.
Okay, that's interesting. So you're saying there will be a rate hike in this policy, then there'll be a pause, and towards the end of the year, we're looking at a rate cut. So perhaps this is the end of the rate tightening cycle, at least in the US. Do you think that could be the case in emerging markets like India as well? And if yes, what should the most prudent strategy be as an equity investor now?
Yeah, I think within India, we've seen signs and signals from the RBI already that they have a pause, I think, in terms of the last action that was seen in April. For India equities, well, our view globally for equities is that we are underweight because the US, we think, will enter recession, and Europe as well. And then within that, though, what we really like is Asia ex-Japan, and in particular, China. And the reason is because we think it's just at a different point of the cycle. For India itself, we have a neutral view on India relative to Asia ex-Japan, but relative to global, we think India can outperform. And why is it neutral within Asia ex-Japan? Why we prefer China relative to India? It's just a function of valuation. I think the India equities is about a 50% premium right now to Asia ex-Japan, when historically it's about a 38% premium to Asia ex-Japan. So it's come off its highs, but it's still a bit elevated. That's why we're neutral on India. But in terms of the earnings that is being delivered, I would think India continues to deliver very, very strong earnings. And the way we would play the market in India, which we prefer the large caps, sector-wise, we prefer financials, industrials, and staples in India. These are sectors where we think it's more attractive from the valuation and from the earnings delivery point of view.
All right, Fook, you also mentioned that you like some banking names, but any view on the IT stocks here in India, because they have been relative underperformers, or would you like to avoid IT?
Yeah, we're a bit more neutral there. I think it's not really, I wouldn't go into any stock specific, but in terms of our preference, we think, the financials, in terms of the credit growth, we see that continuing to grow. And then that's why we like it. Within staples, it's a bit more defensive. And then industrials with the infrastructure and the government policy, incentives for manufacturing. But for the tech, I think we're neutral at the moment.
Right, Fook, I'm not sure whether you'll have a view on crude, but crude oil prices have corrected quite a bit. And from an India perspective, well, we are celebrating that. But since y'all are factoring in a recession, do you think crude oil prices dip further from here as a house? I mean, do you have a view?
Yeah, we do have a view. I think over a 3-month, we see the WTI as staying around $75. But on a 12-month view, we do see it weakening a bit more. And we look at the demand forecast out there. And the demand forecast compared to 6 months ago very clearly has been coming off. Whether you look at the IEA or the EIA, all of the estimates are coming off, and from OPEC Plus as well, it's been coming off. Now, what happened a few weeks ago, of course, was a surprise cut in supply by the OPEC Plus, and that actually helped the oil prices a little bit. And so on the 3 months, we think it can be supported, but on a 12-month view, we do see the WTI weakening a little bit from here towards the $70 mark, just because of the demand and the recession that we expect, especially in the US.
All right, Mr. Yap, thank you very much. Good speaking with you. Appreciate you joining in with that perspective. Appreciate it.